Margaret Calloway was 71 years old, sitting at her kitchen table in Dayton, Ohio, doing what she had done every April for the past 40 years, organizing her tax documents. Alone. Her late husband Dennis used to handle the taxes. He was the one who watched the business channels, read the finance magazines, kept tabs on what changed in Washington. But Dennis passed 2 years ago, and Margaret, a retired school librarian with $284,000 in her IRA, a $1,440 monthly Social Security check, and a small pension from the state, was doing her best. She handed her folder to her tax preparer. Same preparer, same process, same result. A $1,847 tax bill. She paid it. She always paid it. What Margaret did not know, what nobody told her, what no letter arrived in her mailbox to explain, is that Congress passed a law in 2025 that created a brand new $6,000 deduction specifically for people like her, and her tax preparer filed her return without it. My name is Jonathan Mercer. Every week on Tax-Free Retirement, I break down the tax rules, the hidden traps, and the strategies that protect retirees from the things nobody else is explaining. Before I go further, I am not your personal tax advisor. The numbers in this video are based on current 2026 IRS guidance and verified against official government sources. Every situation is different. Please check with a qualified tax professional before making decisions. Now, what I am about to show you is real. It is sitting inside the law right now. And if you are 65 or older, there is a very real chance you qualify for a deduction that could put hundreds, and in some cases, over $1,000 back in your pocket this year. But there is a catch. And number 3 on our list today is where most people lose money without ever knowing why. Stay with me. In July 2025, Congress passed a law called the One Big Beautiful Bill Act. It was signed into law on July 4th, 2025. Buried inside that legislation, past all the political headlines, past all the noise, is a provision that directly benefits retirees. As of the 2025 tax year, which is the return most of you filed in early 2026, or will file if you requested an extension, taxpayers who are age 65 or older may claim an additional $6,000 deduction per person. If you are married, filing jointly, and both spouses are 65 or older, that becomes $12,000. This is confirmed directly in IRS guidance. I checked it before writing a single word of this script. Now here is what makes this different from anything that existed before. This is not a replacement for your standard deduction. This is not a replacement for the existing extra deduction seniors already receive. This stacks on top of both. Let me show you the math, because this is where people stop reading articles online. But the math is the whole point. For the 2025 tax year, the return filed in 2026, a single filer age 65 or older already received a base standard deduction of $15,750, plus an existing additional senior deduction of $2,000. That was $17,750 total. Under the One Big Beautiful Bill Act, you now add $6,000 on top of that. Total deduction for a single filer age 65 or older, $23,750. For a married couple both age 65 or older, base standard deduction of $31,500, additional existing senior deduction of $3,200, new enhanced senior deduction of $12,000. Total, $46,700. That is $46,700 that does not get taxed. Let me put that in terms that matter. If you are in the 22% federal bracket, which is where a lot of middle-income retirees land, a $6,000 additional deduction means $1,320 less in federal taxes this year. $1,320. Over the 4 years this law is in effect, 2025 through 2028, that is $5,280. That is a used car. That is a year of prescription costs. That is 4 round-trip flights to see your grandchildren. And most retirees are leaving it on the table because they do not know it exists. But before I show you who qualifies and who does not, And this is critical because there is an income cliff that can wipe out part of this benefit. I need to show you the second thing this deduction quietly affects, because it is not just your tax bill, it is your Medicare premiums. And that is where this gets complicated in a way that nobody is talking about. Let us start with the part that is simple. To qualify for the $6,000 enhanced senior deduction under the One Big Beautiful Bill Act, you must be age 65 on or before the last day of the tax year. That is it for age, December 31st of the tax year. If you turned 65 on December 31st, 2025, you qualify for the 2025 return. There is no asset test, no savings limit, no requirement that you stopped working. But here is where it gets complicated. The deduction phases out, meaning it shrinks, once your modified adjusted gross income, or MAGI, crosses $75,000 for single filers. For married couples filing jointly, the phase-out starts at $150,000. How does the phase-out work? For every $1,000 of MAGI above the threshold, the deduction is reduced by $60. So for a single filer at $75,000 of income, full $6,000 deduction. At $100,000, the deduction has shrunk by $1,500, leaving $4,500. At $175,000, the deduction is completely gone. This is the cliff most people do not see coming. And here is the cruel irony nobody is talking about. The types of income that push retirees over $75,000 are often the same income they have no choice but to take. Required minimum distributions, Social Security, pension payments. You did not choose to have this income. The IRS requires you to take RMDs. The government taxes your Social Security. Your pension arrives whether you planned around the threshold or not. So you may be getting pushed over the cliff by income you cannot avoid. That is not your fault. That is the design of the system. But there are legal, documented strategies to reduce your MAGI, and we are going to cover those, because the window to use them is not closed yet. Here's the fact that sounds wrong but is true. The $6,000 enhanced senior deduction can reduce your federal income tax bill, but it does not reduce the income Medicare uses to calculate your premiums. Read that again. The deduction lowers your taxable income for IRS purposes, but Medicare uses a different number called Modified Adjusted Gross Income, or MAGI, which is calculated before the enhanced senior deduction is applied. Medicare Part B and Part D premiums are based on what the Centers for Medicare and Medicaid Services, CMS, calls the Income-Related Monthly Adjustment Amount, or IRMAA. For 2026 Medicare premiums, CMS used your 2024 income. That is the look-back period, 2 years. Here's what that means in real dollars. The standard Medicare Part B premium for 2026 is $202.90 per month. But if your 2024 MAGI as a single filer exceeded $109,000 or $218,000 for a married couple filing jointly, you may be paying more. Significantly more. At over $109,000 and up to $137,000 of 2024 MAGI for single filers, or over $218,000 and up to $274,000 for joint filers, your 2026 Part B premium can jump by about $81 per month. That is about $973 per year, per person. And if both spouses are paying that surcharge, that is about $1,946 per year in extra Medicare costs, on top of regular premiums. The new $6,000 enhanced senior deduction does not touch this number. So it is possible, and this happens more than people realize, to take your enhanced senior deduction, feel good about your lower tax bill, and still be paying hundreds of dollars per month in excess Medicare premiums because your gross income pushed you into an IRMAA bracket 2 years ago. Nobody sits you down and shows you how these two systems interact. There's no letter from Medicare explaining this. There's no notice from the IRS. Two separate agencies, two separate calculations, one retiree caught in the middle. And number three, which I'm getting to right now, is where retirees lose the most money of all. Not because they ignored this, but because they did exactly what they were told. Let me introduce you to Raymond Ostrowski. Raymond is 68 years old. He retired from a manufacturing job outside of Pittsburgh, Pennsylvania 3 years ago. His wife Carol is 66. They file jointly. Raymond has a $540,000 traditional IRA. Carol has a small 401k from her years working in hospital administration. They are exactly the kind of couple this law was designed to help. In theory, they qualify for the full $12,000 married couple enhanced senior deduction. In reality, they may lose a large portion of it, not because they made bad decisions, but because of 4 specific situations that nobody warned them about. Situation 1. The RMD threshold problem. Raymond turned 73 in 2025. Under the Secure 2.0 Act, passed in December 2022, the required minimum distribution age is now 73 for people born between 1951 and 1959. So Raymond must take his first RMD from his traditional IRA. Based on his $540,000 IRA balance at the end of 2024 and the IRS Uniform Lifetime Table Life Expectancy Factor of 26.5, Raymond's 2025 RMD is approximately $20,377. Add his Social Security, Carol's small pension, and their investment income, and their combined MAGI lands around $112,000. That is under the $150,000 joint filer threshold. They keep most of the deduction. But here is where Raymond almost made a catastrophic mistake. He was considering a Roth conversion in 2025, converting $60,000 from his traditional IRA to a Roth IRA. If he had done that, their combined MAGI would have jumped to approximately $172,000, above the $150,000 joint filer threshold, and they would have lost approximately $1,320 of their $12,000 enhanced senior deduction. $1,320 in lost deduction, plus the taxes owed on the conversion itself, in a single year. He did not know those two decisions were connected. Situation 2. Tax-exempt bond interest. This one shocks people. Interest from municipal bonds, the kind financial advisors often recommend to retirees because it is tax-free, counts toward your MAGI for the purpose of calculating both the enhanced senior deduction phase-out and IRMAA. It sounds impossible. Tax-free income that counts as income for these purposes? But it is in the law, verified against IRS guidance. So if you are earning $8,000 a year in municipal bond interest, thinking it is invisible to the IRS for deduction purposes, it is not. It is being added back into the income calculation that determines how much of your $6,000 you actually keep. Situation 3. Capital gains from property sales. Many retirees sell a rental property, a second home, or even their primary home above the exclusion limit. Capital gains, even long-term capital gains, count as MAGI. A retiree who is otherwise well below the $75,000 threshold can sell a rental property, realize $45,000 in capital gains, and lose some or all of their enhanced senior deduction in a single transaction. This is not about being rich. This is about one real estate transaction in a single year changing a tax calculation most people did not know existed. Situation 4. Delayed first RMD. The Secure 2.0 Act allows people taking their very first RMD to delay it until April 1st of the following year. Sounds helpful, and it can be in the right situation. But if you delayed your first RMD to April 1st, 2026, you now owe that RMD plus your regular 2026 RMD, both in the same calendar year. 2 RMDs in 1 year, both count as ordinary income. Both push your MAGI upward. That double RMD year could be the year that pushes you over the enhanced senior deduction phase-out threshold and simultaneously into a higher IRMAA Medicare bracket, raising your Part B premiums 2 years from now. The decision to delay was technically allowed. Nobody told you it would cost you in 3 separate places. Let me go back to Margaret Calloway in Dayton. She filed her 2025 taxes in March 2026. Her preparer, a competent person, a good person, did not claim the enhanced senior deduction. Whether it was an oversight or unfamiliarity with the new law, the result was the same. She paid $1,847 in federal taxes. With the $6,000 enhanced senior deduction applied at her tax rate, her federal bill should have been closer to $487. That is a difference of $1,360. She is not required to refile if she already submitted, but she can file an amended return, Form 1040-X, up to 3 years from the original filing date. The window is still open for Margaret, and it may be open for you. Now compare Margaret to Diane Hartley. Diane is 69. She lives in Scottsdale, Arizona. She is a retired dental hygienist. She has a $190,000 Roth IRA, a $95,000 traditional IRA, and receives $1,680 per month in Social Security. Diane is single. Her MAGI in 2025 was $52,000, well below the $75,000 threshold. She gets the full $6,000 enhanced senior deduction. Her total deduction as a single filer 65 or older is now $23,750. Her taxable income drops from $52,000 to $28,250. At the 12% federal tax bracket, that is $720 in federal tax savings this year. $720 per year. 4 years. That is $2,880. She also stayed below the IRMAA threshold, so her Medicare Part B premium stays at $202.90 per month. No surcharge. And because she holds her savings in a Roth IRA, where qualified withdrawals are not counted as MAGI, she has permanent flexibility over her income level in ways that a traditional IRA holder does not. Same country, same IRS, same year. 2 very different outcomes. The difference was not luck. It was information. This law is in effect through the 2028 tax year. That is 4 years. 4 opportunities to either claim this deduction or miss it. Here is what the people who are doing this right are actually doing right now. Strategy 1. Qualified Charitable Distributions, the QCD. If you are 70 and a half or older and have a traditional IRA, you can transfer up to $111,000 directly to a qualified charity called the Qualified Charitable Distribution, or QCD, under current 2026 IRS rules. The QCD satisfies your RMD requirement, but, and this is the key, the QCD amount is excluded from your MAGI. It never hits your taxable income. It never pushes you toward the phase-out. It never triggers IRMAA. If Raymond from Pittsburgh gives $10,000 of his $20,377 RMD directly to his church or a registered charity as a QCD, his taxable RMD income drops by $10,000. That keeps him further from the phase-out threshold and potentially saves him $1,200 in federal taxes, while also benefiting an organization he cares about. You can find the QCD rules in IRS Publication 590-B. Strategy 2. Strategic Roth Conversion in Low-Income Years. This one requires planning ahead, which is exactly why most people miss it. If you have a year where your income is unusually low, maybe before RMDs kick in or after a pension ends, you can convert a portion of your traditional IRA to a Roth IRA, pay taxes at your current lower rate, and permanently reduce the future RMDs that will push your MAGI up in later years. Smaller traditional IRA balances mean smaller RMDs. Smaller RMDs mean lower MAGI. Lower MAGI means more of your enhanced senior deduction is protected, and your Medicare premiums may be lower 2 years down the road. This is called a multi-year tax strategy. It requires modeling, but the math, done correctly, can save tens of thousands of dollars over a 10 to 20-year retirement. Strategy 3. Timing your income events. Retirees who understand MAGI planning deliberately time when they realize capital gains, when they make large IRA withdrawals, and when they take on part-time work income. If you are planning to sell a rental property, converting a portion of your IRA in the same year creates a double income problem. Separating those two events by even one calendar year, keeping each year's income below the relevant threshold, can preserve the full enhanced senior deduction in both years. This is not tax evasion. This is legal tax planning. It is exactly what the IRS expects sophisticated taxpayers to do. I want to be honest with you about something. This deduction expires after the 2028 tax year. Unless Congress extends it, which may or may not happen, the $6,000 enhanced senior deduction disappears after 2028 returns are filed in 2029. That is not speculation. That is what the law currently says, confirmed in the text of the One Big Beautiful Bill Act. So there is a real window here, 4 years, 2025, 2026, 2027, 2028. If you are 65 today, you have 4 years of this. If you are turning 65 this year, you have 3 years. If you are already 73 and taking RMDs and have not been told about the MAGI interaction, the qualified charitable distribution strategy, or the phase-out cliff, you may have already lost some of this money in 2025. You can still file Form 1040-X to amend a prior year return within 3 years of the original filing date. If you filed your 2025 return and the enhanced senior deduction was not claimed and you qualified, that amendment could be worth over $1,000. You are not too late. But the window does not stay open forever. Here is what I want you to do this week. Step 1. Go to irs.gov and search Enhanced Deduction for Seniors, or One Big Beautiful Bill Senior Deduction. Read the IRS guidance directly. Confirm the rule exists and what it says. Do not rely on anyone else's summary, not even mine. Read the original source yourself. Step 2. Find your 2025 tax return, Form 1040. Look at line 12. This is the standard deduction line. Look at the worksheet that shows whether the additional senior amounts were applied. If you do not see a $6,000 adjustment and you are 65 or older, ask your tax preparer directly. Was the enhanced senior deduction from the One Big Beautiful Bill Act applied to my 2025 return? Step 3. Pull your 2024 tax return and look at your total adjusted gross income, line 11 on Form 1040. This is approximately your MAG. Compare it to $75,000 for single filers and $150,000 for joint filers. This tells you whether you are near the phase-out threshold and whether you need to take action before year-end 2026 to protect this deduction for your 2026 return. Step 4. If you are 70 and a half or older with a traditional IRA, call your IRA custodian and ask specifically about qualified charitable distributions. Ask them how to set one up. This is documented in IRS Publication 590-B. It is legal, it works, and it is one of the most underused tools in retirement tax planning. Step 5. If your 2025 return was filed without the enhanced senior deduction and you believe you qualified, contact a CPA or enrolled agent and ask specifically about filing Form 1040-X, the amended return. The filing window is 3 years from your original due date. This is not complicated, but it requires you to ask the right question. The system is not going to come to you. There is something that stays with me about Margaret Calloway. She paid $1,360 in taxes she did not owe. Not because she did anything wrong, not because she was careless, because she trusted a system that quietly added a benefit she was entitled to and then did nothing to make sure she knew about it. No announcement on her Social Security statement, no update from Medicare, no letter from the IRS saying, "Here is a $6,000 deduction with your name on it." Nothing. That is how this works. Benefits exist. Deductions pass into law. Thresholds change. And the people who are sitting at kitchen tables in Dayton, Ohio, in Tampa and Boise and Raleigh and everywhere else are not told. But you now know. And knowing is the difference. Hit like on this video. It takes 1 second. And it puts this in front of retirees who are filing their taxes right now without claiming money they are legally entitled to. Drop a comment below with one word, the city or state where you live. That is it. I read every single one, and it tells me where this conversation needs to go next. This is Jonathan Mercer with Tax-Free Retirement. I will see you in the next one.